Hello, everyone, and welcome to the fundamentals portion of the newsletter for August 23rd. So today we're going to be looking at buying the dip. I finally managed to get my code back up and running, and we're going to run through a number of charts and levels for the coming future. As we move into this bullish market, there is going to be opportunities to step in front of these dips. And the reality is that if our long-term view for BTC is that it is going much higher, then the opportunities of actually getting in there and knowing which levels carry some kind of either historical or probabilistic importance. And then to the next level is looking at things like, cost basis and supply stress and things like that. So there's a layer of, and we'll talk through all of these, there's a layer of where we've got probability and historical precedence. And then there's another layer, which is then there's a fundamental Bitcoin-esque supply side or investor side stress level. And the idea is trying to identify where these zones are that are going to be, profitable levels to actually be looking for entries and places to be stepping in front of the train. And the honest reality is that during bull markets, at least the previous bull markets, Bitcoin has consistently undergone 30%, sometimes 50% retracements along the way to its eventual blow off top. So, there is a layer of actually getting in there and catching knives with the way that Bitcoin has performed in the past. And I think one thing to at least keep in the back of your mind is that this market cycle is very likely to be very different to previous market cycles. And the reason for that is the size of the network. And, we've seen even of late that we're getting far less volatility far more often. If you even think back to 2018, we would get substantial volatility on a regular basis. Nowadays, we're getting much, much less of it. We're getting these long periods where implied volatility and options pricing and all that kind of stuff really starts to consolidate down. We get massive Bollinger Band squeezes. I have heard some rumors that there's some very, very large Bitcoin holders who are more or less trying to actually create this type of environment. Again, it's a lot of this is speculation, but this is certainly something that I've heard. Is that we're getting this, these large players are trying to make it a more attractive institutional investment vehicle. And that's kind of the world that we're moving into, is we're getting all people of large size, very large positions. Lots and lots of the trading that's going on is actually going on in derivatives markets, so external to some extent. And then we also have layers of, short and long squeezes that come involved in that. So, there are going to be strong pullbacks. How this particular market cycle plays out is, it's anyone's guess. But at the least, what we have in this toolbox we're about to run through is some historical precedent that we can use to try and find those key levels. So we'll kick into it. So if we do assume that we have entered the bull market, then the opportune move is to BDF. Right? The idea is to be buying the actual dip and stepping in front of the train. There's going to be lots of weak hands that come into this market over time, and they're all going to get shaken out. All right? They're going to get shaken out from a very large pullback, which you and I have become very accustomed to, seeing a 20-30% move, and then the thing will just turn around and away it goes to the upside. So, the core assumption of everything I'm about to go through is that we are in a bull market. That is my current bias. I think that, the macro environment couldn't be more bullish for the asset. So I really think that this is the place to be. This is the mindset to be in. And really the art of this is trying to find edge as we step in front of the train. So, yes, you may get sliced through if you enter trying to catch the knife, but the notion here is that there's a high probability setup and reason that it will rebound from that point, or a level not too far from it. And what I've tried to do is break these up into kind of blocks. So we're getting pricing that's in around the 9,000 to high 8,000 is kind of a block of support levels. It could take some time to break down through it. Then there's block 2, which is a higher conviction generally. Higher conviction but lower pricing points, 6, 7K, things like that. So I've tried to break this down into levels and blocks of levels, because there's obviously a lot of metrics that we can look at. And then we'll kind of look how they all get stitched together right at the end and look graphically. So there is a bit of a hierarchy of conviction when it comes to these levels. And I've tended to lump these, there's not necessarily science behind this. There's more so observation. A lot of this stuff is empirical and on-chain, and even technical analysis. It's empirical. We look at ascending triangles and we see that 75% of the time or 85% of the time they break to the upside. So we build these contextual frameworks. They never always play out the way we expect. But by actually putting in this kind of framework of a hierarchy where we think there's the highest conviction, and just to talk through some of these, there's your standard trading signals, things like your moving averages. And, a saying that Doc has said that's always stuck with me is in a sea of sand, a single flag becomes a target. And that's more or less what these are. When you've got things like the 128-day or the 200-day moving average, every trader on earth knows about them. And it's such an obvious target for people to be buying at that level. These are kind of the important elements here. They're the ones that I call the magic lines. And there's another layer in there, which is the golden ratios, which we'll touch on. But in particular, the 128 and the 200. There's the fair value model, so things like the stock to flow model, the difficulty multiple, Mayer multiple, MVRV, things like this, things that kind of indicate where we've got a fair value for the asset. Of various methods, and really what you're looking for in this fair value model is confluence. If you can tie together confluence of a fair value model where we've got some probabilistic distribution, which we'll also go through, and that also lines up with a 128-day or a 200-day moving average, and you've got an on-chain level, when you start getting multiple things line up, that's when you start drawing a line saying, hey, this could actually be a fairly strong level to be getting in on. So I consider both trading signals and fair value to be moderate conviction. We're not going to look at things like the 20-day or the 50-day moving average. We care about the long-term moving averages, particularly for buying strong pullbacks. Really what this session's about is not necessarily buying little dips. This is about buying the big dips. This is about stepping in front of the train and trying to get something that's just plummeted 1,000, 1,500, $2,000, right? 2,000 points. That's the kind of stuff that we want to be stepping in and getting that maximum edge on. So that's really what this is looking for. This is looking for the really big angry pullbacks. So I'd consider these two, trading and fair value, to be moderate, right? They're not necessarily, they're levels that people are aware of. They're level lots of people are going to look at, but only in comparison to things like the on-chain levels, things like the realized price, block subsidy models, where you've got miners that are actually under financial stress, and then the long-term 228-week, 200-week kind of, they tend to sit down there as very long-term accumulation levels. Not many people are looking at the 200-week moving average. They're not necessarily on-chain, but I've put them down here in this high conviction level, because this is the kind of stuff that the really big players look at. When we talk about the cargo ship, right, with the monthly chart or the weekly chart as the cargo ship, it takes a long time to turn that thing around. Whereas your little speedboats on your 50-day and 128-day, they can turn their turning circle is much smaller, so they can be turned around much quicker, and therefore they don't hold the same conviction. But in general, things like the realized price is a on-chain psychological level for the investing class. We've got the MVRV, which then gives us some levels above and below that. Pure multiple and block subsidy, they're both representative of minor stress. And you can layer in there things like the difficulty ribbon and stuff like that as well. But for now, we'll stick to these ones that kind of give us a price level that we can actually trade off. So we're basically going to run through them one by one. So historically, and you can see this is the long-term chart for BTC, the 128-day and the 200-day have historically been strong support levels. Now, if of all the tools out here, these are by far the most simple, the easiest to apply on something like TradingView. And more or less in the early stage of the bull, which is where I believe we currently are. I think we're in this early phase, and you can really see that, this would be considered early phase. This would be your early phase through 2016. Then 2017 was our late bull. And likewise here, this is our late bull. And through these, you can actually see down here, the 128-day, which is the purple line, it was the major support. People started to pick up, the 200-day. The 200-day was the major support through the early bull phase, right? People are a little bit uncertain, it's testing the waters, and actually through this early bull, the 200 has been the support level that's held after the March sell-off. And as we move into the late stage, the 128-day starts to kick in because it's a faster moving average. It's still got a lot of strength to it. But certainly there's two phases. There's the 200-day phase, and as it starts to accelerate away, it doesn't actually revisit, or it hasn't revisited the 200-day. We got a retest back down here in the early years, but certainly during 2017, during this big run, the key touches were on the 128 days. So at the moment, I believe that they both stand as valid. Naturally, with the faster moving average on the 128, it will hit that first at 9,600. And then at the upper 8,000s, that's when we have the 200 days. So if we do get an angry pullback at this point in time, this high, low 9,000s level is really where I'd be looking for, right? But by the time we actually do get a pullback, there's a good chance this will be up at 9,000 at the 200 day. So in terms of a very strong level that has historically been early bull market, a good place to buy the dip, the 200 day is probably the right level. And the 128 remains a strong level over time, but obviously doesn't have the same conviction at the 200 day. So there's that trade-off there. So potentially an early catch at the 128 and the 200 for the longer term. And this is where we then plot out, and you can see in the dashed lines is the daily, so the 128 and the 200 daily, in the solid lines is their equivalent, but in the weekly. And you can see that the two weeklies tend to catch the accumulation zone, right? They catch the bottom and the top of the accumulation zone. So in the worst case scenario, we have the 128 week sitting down here at 7,500. I really don't think we're going to get down to that level. I think if anything, setting a somewhere in this $9,000 range would be. I'm not saying that's where I think it's going to go, but if there's going to be an angry pullback, it's going to be somewhere in that block. And you'll see there's a number of these moving averages that line up here. And as we go through these modules, the idea is that there's I've tabulated all of these into the different block levels. So at the end of each of these sections, you'll have a bit of a summary of where those key levels are. And then you can start matching it up with things like your technical analysis and other layers like that. So the golden ratios. Now this is an interesting chart that was developed by Positive Crypto. So you can find this at the website down the bottom there at Look Into Bitcoin. Now what this is basically doing is it's taking the yearly average, the 356-day moving average, and then it applies some natural numbers to it, like basically the Fibonacci levels, as well as the golden ratio. And what that's basically telling us, that's this yellow line running in through here. This yellow line here is sitting around 8,700. So now look, the reality is that for whatever reason, human psychology and the way people perceive price just seems to move alongside these kind of natural moving numbers, Fibonacci levels and things like that. For whatever reason, we've tended to see in this early bull market that at the very least it starts to set this kind of price floor. So this is what I don't think we're going to come back and revisit this level, but there is some distance that kind of, it's a consistent distance between this in the early bull, this yellow golden ratio level and actual price level. And we kind of saw this back through here as well. And these levels here, you can kind of think about them as Fibonacci levels to the upside, and also that bottom catching level. And you can see here that through the accumulation zone, it was quite some distance below it. Again, accumulation zone. So really, I'm not expecting it to get down to this $8,700 level. I think we're going to catch some kind of support higher than that. But this is just another useful metric that gives you kind of a natural the 1 year moving average, and then taking the natural ratio of that, golden ratio of that. So if we look at some of these moving averages and just look at these key levels, really we've got this top block here, which I'm calling upper 8,000s to 9,000. So there's a 1,000 point range in there, more or less. But 1,000 points in an angry pullback is fairly common. And really what we've got here, my honest opinion is I don't think we're going to get down below the 200-day moving average. I think there's going to be a lot of traders, sea of sand. There's going to be a lot of traders looking at these levels, and I think there's going to be a lot of traders buying them. So this is kind of if there's going to be an angry pullback, this is where I think we're going to be paying the most attention in this block 1 zone. Naturally, I have to give these a lower strength in terms of the likelihood of them holding. The 200 days clearly more than the 128 day. And then obviously we've got our weekly levels, and I've added in there our Mayer multiple, which we'll come to shortly. As a percentage ratio, you're starting to see that block 2, in around the 7,000s, and then, very low, and you'll often see this, the slower, more higher conviction moving averages or realized price, these kind of things, they tend to be quite some distance below, almost 50% pullbacks. But 50% pullbacks are also not impossible in Bitcoin's history, particularly in these early bull phase, where it's kind of in this uncertain realm where people are not sure whether it's quite the bull, and you can get panic selling and things like that. So these 3 blocks will be consistent through all of these, and you'll see that prices all tend to line up. So what we're starting to see here is, top 8,000 to 9,000, the 9.5, in the 7,000s, low 7,000s, and then the 6,000 to 5,000 range is that really strong level of support, unlikely to be revisited. But if we do revisit it, these are your levels to be watching. So just a quick refresh on probability distributions. I run this for all of the metrics that we're going to run through from here on. More or less what this chart is doing. Now, obviously, there's lots of colors and lines and things, but let me explain it in short. Basically, if we look at the Maya histogram, right, these red bars, this is basically saying through Bitcoin's history, a Maya multiple value of 0.2 has occurred approximately, let's say that's about 75 times. There's been 75 occurrences in all of Bitcoin's history where it's been about between 0 and 0.2. Between 0.2 and 0.4, we're talking about just over 100, and so on and so forth, and you build this curve. Now, what we're kind of seeing here is that the bulk from all of these metrics, in fact, is somewhere in the range of, let's say, 0.4 to about 1.2. This is kind of the bulk of what's going on. This is where most of the trading zone is. You can kind of consider this, where is its normal realm, right? Where does Bitcoin normally trade? And because everything's kind of an oscillator, and a lot of these fair value models tend to approximate the long-term mean, the idea is that as the coin price moves around, it's going to oscillate around these centers of gravity. And that's what this is really showing. These centers of gravity here is where the price wants to trade. And when you go very high, you get into those extreme values that really don't occur very often. There's a high likelihood that it's overstretched to the upside. It means price has gone much higher than where the gravity wants to pull it back to. And likewise, down in these lower zones, it's where price has fallen a very long way. So this is our dip buying zone. It's fallen a long way, and the elastic band wants to bring it back into the center. Now, these curves here, what's called the cumulative distribution function, and it's basically saying it's summing all the way along. So, let's take this yellow line here. This node here is saying that if you sum all of the yellow bars from here to here and divide it by the total that's occurred, that encapsulates about 30% of all history. If we keep going up higher, this bar here is saying if you sum all the bars behind, so this is 1.8, so from 0 to 1.8 captures 70% of Bitcoin's trading history, 80% of Bitcoin, 90%. And you can see we're actually getting a very similar shape for all of these metrics. And this is how we define our probabilities. So for example, if we look up here where there's a very strong cluster, almost all of the metrics are saying above 3.6, if any of these metrics get above 3.6, there is only 10% of Bitcoin's history that has ever been at a level like that. So if you switch that around and you flip it, you say, okay, if it's only been up there for 10% of Bitcoin's history, that means that there's a 90% chance that it wants to come out of that zone, right? Because if it stays up there forever, it's a very unlikely scenario for it to be overvalued for very, very long periods of time. So the elastic band wants to pull it back down towards this range. That's what this is really saying. And quite interestingly, I've run this calc for a number across, each year, right? Looking at it 2012, 13, 14, 15, and we get a very similar pattern. So, historically, these things are approximating the mean and the center of gravity. So, this is the elastic band, and this is where these probabilities come from as we keep going through this. So this is a summary table. You can probably use this as you look at these fair value models, but looking at what different levels give us that 10% probability of a buy. So this is saying that there's a 90% chance to do one minus, 90% chance that it wants to go higher. This is an 80% chance it wants to go higher. Once we move into the sell zone, the 10%, this is saying that there is a 90% chance that it wants to now go lower and move away from this level, and this is a 95% chance. And the reason that these are smaller than the buy levels tend to be long accumulation bases. So there's more time for people to get in and buy these things. The blow off tops are short, sharp, super overvalued type levels. And that's why we use this 5%, because once it gets into the 5%, it's really time to start taking some profits. So that's where these come from. And this is for the 200-day moving average, or the Maya multiple, stock to flow, and the difficulty multiple. And then I've just taken an average, so you can kind of use this as you look at the different metrics that are out there on the internet. You can use these levels as kind of your gut feel level, or if you're looking at an individual metric, you can use these ones here. So we'll fly through these. The Maya multiple, 200-day moving average, we said before, it's about 9,000. The 20% probability for buying a dip, so there's an 80% chance to want to go higher, is low 7,000s. And then the 90% chance, so this is the very strong buy level at this 0.7 times your 200-day moving average, and that's what these bands are really showing. is down at 5,400. So that's again block 1, block 2, block 3. The stock to flow model, so if we look at I think this is the 365-day moving average of it, it currently wants price to be up at 13,500. So, and you can see that it started following, so I'm sure Plan B's pretty pleased with this. But the 20% level for this is down at 6,000. So this is in at block 2. And then the 10% is right down at 4,000. And again, I'm skeptical that we're going to get down to a level like that. It would be possible if we had some kind of major sell-off in the equity market and there's a real risk-off scare, which could happen, by the way. So that's why I've tried to present all these levels. That is certainly an outcome that we should be aware of, and it is possible. But I think if we get normal trading, it's probably unlikely. I think that the March sell-off was really the big rinse that we were looking for. Now, the difficulty multiple, this is taking, it's almost the same as the stock to flow multiple, except instead of using stock to flow, we use the difficulty. And this is actually, in my personal opinion, this is far sounder than so the stock to flow multiple is a forward-looking metric. The idea is you can use it to look into the future. Difficulty, obviously, we don't know what the future difficulty is. However, the difficulty multiple kind of captures all of the behavior of miners, all the complexities, it all distills down to a single number. I like this level as a strong support level. You can see that it's really captured a large portion of recent trading history. I like this mid 9,000s as kind of a real strong level. You've got a strong technical support. You've got the 200-day moving average in there. The difficulty multiple actually lines up with the 128 days. So there's two strong metrics that line up in that position. And then again, both of these down in block 1 actually. So the 20% range, in order for the difficulty and to put the miners in serious stress, we need to get down into the $4,000, $3,000 range, which I think again is an unlikely level. That would really be revisiting down here, and I just don't think that's a likely scenario. But I like this level at 9,600 as a angry pullback. So summarizing these again, stock to flow, I've kind of ignored this one because it's obviously higher than the price, so not really buying the dip. This is the one here I said difficulty. It also lines up with 128 day. This is a good level. I'm keeping track of this, and I've given it a B plus level. And then we've got the 200 day below that. Once we move into block 2, again, we're talking about that low 7,000s type level. This will give us an 80% chance on both the Maya and the stock to flow to keep going. And if we look at the 10% chance of Maya and the 20% difficulty, we're down again in block 3. But again, I think these are the unlikely levels. So again, seeing that 9,000, 9,500 level is a strong level. And I like the difficulty multiple because not many people are watching it. People will be watching the 128 day and they might be waiting for the 200 day, but having both of these together is a strong level in my opinion. So now we move into the psychological levels. Now these are all much, much lower than price. These are what we're looking for if we get a 50% haircut. It'll be angry, but these are the levels that will, in my opinion, hold very strong. So the realized price is the last time that everyone moved their coins. What's kind of the average cost basis of the market? And that's down here at 6,000, all right, 6,200 more or less. We can then take our 80% and 90% chance to return to mean, or 20% and 10% probability of occurrence. And we're down in this block 3 zone, 5,500, 4,000. 4,500. So, if it does get really angry, then the realized price, and you can see that it actually got bought up during the March sell-off. It was obviously the accumulation zone following our capitulation event back in December. It was the accumulation zone on both of the previous cycles. So, and then, we always get this retest, but I think this was our retest equivalent to this guy here. I don't think we're going to get down to that level unless things get really, really grim. Now, the Puell multiple, this is an interesting one. So this is looking at miner income, the 365-day of miner income, and just comparing what today's income is compared to their yearly average. Now, this is going to be somewhat skewed because we just had the halving. So within that 365 days, we've got, 3/4 of it is actually with a higher block reward. And you can actually see here that 3/4 is now showing up as a Puell ratio of about 0.75. So what this is actually telling me is that miners are more or less at the stable equilibrium point, which makes sense because it lines up with the difficulty multiple. So what this is telling me is that yes, their current income is less than it has been for 365 days for the average. However, during the last quarter of that, we've had a halving event, which has actually halved their income. So it does make sense that they would have planned for all of this. So in my view, what this pure multiple is actually telling us is that we're at fair value, and that's kind of what the difficulty level is telling us, which is a little bit above that fair value level. And if it did fall down to that difficulty multiple at, what was it, 9,600, this pure multiple would technically say miners are in stress, and again, it would be a strong buy level. You can see it would probably drop down and touch the top of this red zone. So again, that's kind of another metric pointing at that 9,500 level for buy the dip angry. And the block subsidy model. So this is an interesting one. This is a little bit less tested for Bitcoin. It certainly works very well for Decred. For Bitcoin, however, this is something that Permal Nino came up with. And what he basically looks at is the cumulative, or the thermocap, the cumulative proof of work USD rewards paid to miners. And he does the sum, right, across the whole history. And that's what those blue lines are. Now, if you then take, and you can see back in early history for Bitcoin, it dipped below, it touched the 1x. So this means that the cumulative amount paid to miners was tested by price, and then away it went. You can see that all of these blow off tops have actually been on the 64 levels. So this is part of our sell the top levels. During the second cycle, it came down and touched the green 2x level. So this is the cumulative rewards paid times 2. So you can kind of think of this as it's doubled its monetary premium. And during this cycle, it came down and touched the 4x. And more recently, we've been testing the 8x over and over again. So just to give you some levels here, in terms of a potential topping level, some kind of local top, 16.5 kind of lines up with that. And that would also mean, because it's we saw the stock to flow multiples around 13,000. This would then be 3,000 above that, which is roughly 25% or thereabouts. So we would actually be moving into that upper range of the stock to flow multiple. There'd be a potential, short local top somewhere around there as well. 8,000, so 8,300. If we assume this keeps going up a little bit more, that's kind of our next level, which again would be a strong technical analysis support, but also a level of kind of monetary premium support. So there's a level there, and then down in block 3 again, we've got another 4,000. So there's a number of metrics that are pointing to that being a very strong level, unlikely to go lower than that. So again, in block 1 we've got 8,000, 8,300. Block 2 we're again in that 6,000, upper 5,000s, and then block 3 we're down in the 4,000 range. So these are kind of our strength levels for what we're probably looking for. And if we just go and stitch all of these together, let me pull up. So this is a chart that I spent some time trying to get it to look nice, but there's just so many lines. It's challenging to keep track of it all, to be honest. So this is pulling in all of those different metrics, right, that we've just been looking at. I've taken out a lot of the topping signals, they're in there as well, but to keep it clean, we're looking at all of our buy the dip levels. So we said before that our this doesn't have a fair value model, so our difficulty level is going to be in here at about 9,600, I think we said. So this level here, from a sense perspective, it makes a lot of sense. For this zone in here, our technical analysis level, this to be a strong support level. Our 200-day moving average is in there, our difficulty multiple is in there. There's a lot going in block 1, which is really what we're seeing in this particular block here. I've broken it now. Hang on. So that would be our block 1 zone, right, where we're in that 9,000s range. Now, if we get a really, really angry pullback, right, something that really wants to test the strong hands, the first layer that we're looking at, which actually lines up with a lot of this kind of accumulation zone, this reaccumulation, we've got our thermocap, our 8x thermocap down at 8,000. We've got our buy zone for, this is the 2-year moving average in here. And we've also got, so that's 128 week moving average. So this is our block 2, right? Where we're talking about something in the range of 8,000 up to 7,000. So, block one is really within the zone, our previous trading range. That would be buy support level number one, mid 9,000s. Buy support level two is then about 8.5 to 7,000 to 7.5, that kind of $1,000 range, which again lines up with these previous accumulation levels. And then these solid lines down the bottom here is where we're getting into that really strong fundamental psychological cost basis level support. So, we've got our 200-week moving average, which again, you saw that it caught this bottom. It caught this bottom, and it's actually caught all the previous bottoms as well. So the 200-week moving average is a real slow-moving, strong beast that's really going to catch it. And that is lined up with the realized price. So, these guys here at 6,500 and 6,150. So in honesty, I really don't think we're going to get down there. If we do get there, these would be generational by the dip levels. These would be that 50% pullback, shake out all the weak hands, mass liquidation, and you'd be stepping in front of the train somewhere down here. So that really summarizes our three zones for buying the dip at this point in time. 9,500, mid 7,000s to 8,500, and then down here at the $6,000 mark is where we have that really strong psychological support. So hopefully that gives you a bit of a run through on what's going on, and where those high conviction buy the dip levels are. What I'll do is I'll send the this thing out as a presentation, so that people have actually got this, and you can use these levels and keep track of the actual numbers yourself. I wouldn't be surprised if we got a big pullback. Maybe something like a 20-30% correction. Got to go lower to go higher. I think it will probably take a lot longer than people expect. It could very well dip down and then shoot back up, and away it goes. But we're certainly seeing the market behaving in a much more slower and more methodical manner these days. I think there's a lot more money that's being rolled around in it, and I think there's a lot of whales who are trying to build that stability to create the more institutional investment sphere. So I do think that's going on. It is it is a rumor to some extent, but it's certainly something that I've heard in some of the bigger trading circles. So it's just something to kind of be aware of. But hopefully this gives you a few levels to be keeping track of and looking for those high conviction entries. And as always, let me know if there's anything else that you want me to cover in the coming weeks. Anything that you've kind of got in your mind. And as we move into this bull market, and start getting towards towards the top, we'll start looking at levels that we can start actually taking profits at. And in particular, an equivalent module for this, but looking at the high conviction exit signals. So trying to find things like the where the stock to flow multiples and the Mayer multiples are really blown off, things like the top cap and the block subsidy level, which is that 64 times cumulative block rewards. And just for reference, for people who are looking for resources to actually track a lot of these things, let me just bring in, give me 1 second as I bring in this guy here. So there's a few different sites that are really useful, just a closing note to keep track of these things. One that I find really, really useful is Look Into Bitcoin. They've got this section on charts, and they've got a whole lot of these. They've got their, there's a 200-week moving average, which is that bottom catching level. They've got the MVRV, the pure multiple, stock to flow. I like this stock to flow multiple actually more than the other one that I'll show you in a second. But they've pretty much got most of the metrics, the golden ratio, things that you're going to be keeping track of. And the toolkit that we've just gone through, those tables and the percentage multipliers, lots of people have these charts, right? These are all publicly viewable. The edge that you all have is knowing what those probabilities actually look like. And to be honest, you can go back and look at the probability distribution function, and you can actually use that, and let's just do a quick example just to make it, to really lock it in. If we go to, where are we? This one here. Let's say, for example, we want to look at, which was he pointing to? The stock to flow, right? So this is this blue line. If, for example, the current, let's say that we want something of a 20%. So we're talking about 0.6, right? If you take this blue line, drop it down, 0.6 is our metric. If we now jump to the stock to flow multiple, so let's zoom in. We can see that the current stock to flow multiple is about 13,600. And we know that our 20% level is 0.6. So take the estimated price at today's level, 13,600. If you multiply that by 0.6, that will then give you a band down here that is where your 20% probability of occurrence or 80% chance of reverting back to towards this center of gravity line. That's how you would use this. Same for the MVRV. If you go and find the MVRV ratio, you can then multiply that by the realized price. If you get 0.4, for example, you multiply that by realized price, and that will then tell you where that 20% confluence level is. That's how you use this. You take the multiple level and you multiply it by the actual metric, the estimate of price based on that metric. If we go to digitalic.net, this one here is, again, this is another one of those sites that's got a very large collection of these different metrics. The particular one that I think is worth paying attention to here is they've got the stock to flow, but they also have, in the bottom red one there, the difficulty model price. I believe this is the only place that I've seen the difficulty model actually presented in public charting. So this is another one that you can come to and keep track of, is that difficulty price. You can then multiply your from your probability curve by that difficulty price, and that will then give you a separate level for those probabilities. So that's really the edge that that you have from using these this particular session. Is the edge that you have is knowing what those probabilities are, and that's what most people in this do not have. They know the level and they know where the fair value is, but what they don't know is where the probability of mean reversion is when it falls or rises. That's the edge that's there. So they're the two sites that I would use, is the Look Into Bitcoin and the digitalic.net. Again, if there's anything that you want me to cover, just grab me in the chat room and we'll pick it up next week. Otherwise, thanks for tuning in. Cheers.